If you're focused on building a great credit score, there's a decent chance you're paying more than you need to, taking on debt you don't actually need, or optimizing the wrong target. The credit score system rewards behaviors that are profitable for lenders, not behaviors that are optimal for your long-term net worth. Here's the real problem. Many people treat a credit score as a financial asset. It isn't. It's a risk pricing tool used by banks and insurers. A high score can lower the cost of borrowing, but it can also quietly push you into borrowing more often, keeping more accounts open and prioritizing score hygiene over cash flow strength. Most people think they're doing everything correctly because the common advice sounds responsible: keep utilization low, keep old accounts open, use credit regularly, never miss a payment, mix credit types. None of these rules are inherently bad. The mistake is following them as a strategy instead of treating them as constraints while you build actual wealth. The financial consequence shows up in numbers, not opinions. Let's take a simple example: a $25,000 auto loan. If your rate is 6% instead of 9%, the difference looks small monthly, but it's real money. On a 60-month loan, the payment at 6% is about $483 per month. At 9%, it's about $519 per month. That's roughly $36 per month, or about $2,160 over the life of the loan. So yes, credit score matters. But here's the trap. People spend years gaming a score to save a few $1,000s on occasional loans, while ignoring bigger, more frequent leaks, carrying balances, paying high fees, buying more expensive cars/homes because the bank approved it, or keeping cash reserves too low because they're prioritizing utilization metrics. One missed step in this direction can overwhelm the benefit of a slightly better interest rate. Another example: carrying a $3,000 credit card balance at 24% APR costs about $720 per year in interest if you keep it around that level. If improving your score leads you to open more cards, spend more to keep them active, or delay paying down debt to manage utilization, you can easily lose more in interest than you'll ever save from a higher score. So the issue isn't that credit scores are useless. It's that many people treat the score as the goal, and that tends to increase borrowing behavior. The score can reduce the cost of debt, but it can also normalize debt as a permanent tool in your life. In the next section, we'll break down why the system incentivizes this and how doing the right things can still lead to paying more overall. This problem exists because many households operate with thin margins. Fixed monthly obligations are high, liquid savings are low, and income is not perfectly stable. In that setup, credit becomes a practical substitute for an emergency fund. Once credit plays that role, the credit score becomes psychologically linked to security, because it determines how easily you can borrow when something goes wrong. That's the first driver. The more fragile the cash flow structure, the more people treat the score as a priority, even when the underlying balance sheet is weak. The second driver is behavioral and systemic. A credit score is simple, visible, and constantly updated. Net worth, savings rate, and the sustainability of fixed expenses are harder to track and require a system, a clear budget, an emergency fund target, a payoff plan, and automated investing. People optimize what is easiest to measure. Lenders and fintech apps reinforce this by providing dashboards, alerts, and tips focused on score movement. The incentives align. A consumer who actively manages a score is more likely to keep accounts open, use credit regularly, and remain a long-term borrower. Here's a concrete example. Someone carries a $6,000 balance across cards with a total limit of $20,000, so utilization is 30%. They've heard keep utilization under 10%. Instead of focusing on eliminating the $6,000 permanently, they keep $6,000 in savings, earning around 4%, and make extra mid-cycle payments to keep the reported balance low when statements close. That can improve the score, but it doesn't improve their financial reality if they're revolving debt at 22 to 28% APR. The math is straightforward. A $6,000 balance at 24% APR costs roughly $1,440 per year in interest. A $6,000 savings balance at 4% earns about $240 per year before tax. Optimizing reported utilization while keeping a revolving balance is a negative spread that quietly transfers wealth to the lender. A second example is the credit builder with a tight budget. Suppose someone brings home $4,000 per month. Fixed costs, rent, car payment, insurance, minimum debt payments total $3,200. That leaves $800 for groceries, utilities, transportation, and everything else. They open new credit lines to build credit, keep small balances to show activity, and avoid closing accounts because they've been told it hurts the score. Then a $900 car repair hits. It goes on a card at 24% APR. Now the score becomes the constraint. They avoid aggressive payoff because they fear utilization spikes, they keep accounts open that they don't need, and they keep spending small amounts to keep cards active. The score is improving or holding steady, but the household is one shock away from compounding debt. This is why standard advice often doesn't work in practice. Keep utilization low focuses on a metric that can be manipulated without solving debt. Never close old accounts ignores fees, complexity, and the real goal of reducing reliance on credit. Use credit regularly can normalize consumption smoothing with debt rather than building cash buffers. The deeper issue is not information. It's the absence of a system that prioritizes cash flow resilience and debt elimination first. A strong score is typically a byproduct of that structure, not the structure itself. The first mistake is treating approval as affordability. A strong score increases access to larger loans, but access is not the same as capacity. If a lender approves a $550 per month car payment, many people interpret that as reasonable. Over 5 years, that single decision can block wealth building. Compare two choices. Car A costs $350 per month. Car B costs $550 per month. The difference is $200 per month. If that $200 is invested monthly at 7% for 5 years, it becomes roughly $14,000. Over 10 years, continuing that pattern becomes roughly $35,000. Over 20 years, it's roughly $104,000. Same income, different decision. The second mistake is carrying revolving balances while optimizing score metrics. People delay paying down debt because they're focused on utilization looking good rather than debt being gone. A $5,000 balance at 24% APR costs about $1,200 per year in interest. If you keep that balance for 5 years, you've paid roughly $6,000 just for the privilege of staying in debt, not counting principal reduction. That cost is large enough to materially delay an emergency fund, retirement contributions, or a down payment. It's not a small leak, it's a compounding one. The third mistake is keeping fee-bearing or unnecessary accounts open for the score. A $95 annual fee card kept for 10 years is $950. That's not catastrophic alone, but combined with multiple accounts and other credit maintenance behaviors, it adds up. More importantly, complexity increases the chance of an operational error, missed payments, auto-pay failures, forgotten subscriptions, events that can damage a score far more than any benefit from keeping an old account open. The fourth mistake is confusing a credit score with financial readiness. Many people push for a higher score before they build cash reserves, assuming the score will protect them. In reality, the difference between stability and fragility is often liquidity, not credit. If you don't have $1,000 to $3,000 available for routine shocks, credit becomes the default solution, and interest becomes the penalty. Now compare two 10-year scenarios for someone earning the same income. Person 1 prioritizes the score, opens accounts, keeps balances small but persistent, finances a more expensive car because the rate is good, and maintains low cash. Person 2 prioritizes structure, pays revolving debt to zero, keeps fixed costs low, builds a cash buffer, and uses credit only when the math clearly supports it. The difference is not talent or salary, it's a decision framework. Over 10 years, person 1 can easily pay $10,000 to $25,000 in avoidable interest and extra fixed costs. Person 2 can redirect that same cash flow into investments, debt freedom, and optionality. The core issue isn't income. It's the choice to optimize a lender's risk metric instead of your personal balance sheet. The practical solution is to treat your credit score as a constraint, not a target, and build a system where the score improves as a side effect of strong cash flow and low-cost borrowing. That system has 3 moving parts: liquidity, debt rules, and automated allocations. Start with liquidity because it prevents high-interest debt from becoming your default. Set a minimum cash buffer that matches the volatility of your life. For many people, a workable first target is $1,000 to stop routine surprises from hitting a card, then 1 month of essential expenses, then 3 months overtime. This is not about maximizing returns. It's about preventing 20 to 30% APR debt. Keeping $3,000 in cash earning 4% instead of investing it may cost you some upside, but it can also prevent one $3,000 emergency from turning into years of interest payments. That trade is stable because it reduces the probability of expensive outcomes. Next, implement debt rules that remove ambiguity. Rule 1. No revolving balances. If a credit card balance cannot be paid in full by the statement due date, spending is no longer normal spending. It's borrowing at a high rate. Mechanically, this means using autopay for the full statement balance and building your budget around cash, not available credit. If you already have revolving debt, the priority is simple. Pay it down aggressively before optimizing anything else. The reason is math. Paying off a 24% APR balance is effectively a guaranteed 24% return, which is higher than what you can reliably earn elsewhere without taking risk. Rule 2. Borrow only when the borrowing reduces total cost or increases long-term flexibility. That means you don't finance a more expensive card just because the interest rate is reasonable. You evaluate the entire monthly obligation and its effect on your savings rate. A good rate on a large loan can still be a bad decision if it raises fixed costs and reduces investing capacity. Then set automated allocations so the system runs without constant decisions. A simple structure is, income arrives. To essentials are paid to a fixed amount goes automatically to savings/investing. To debt payoff happens automatically to discretionary spending is what remains. The key is that the wealth-building transfers happen first, not last. If you wait to see what's left, lifestyle inflation usually absorbs it. Where does the credit score fit? It becomes a passive output. You keep utilization low naturally because you're not carrying balances. Payment history stays clean because full autopay is on. Account age improves over time because you stop opening unnecessary products. You only apply for credit when there's a clear reason and the numbers support it. This approach is stable because it does not require predicting markets, timing rate changes, or constantly managing tactics. It reduces high-interest exposure, lowers fixed obligations, and creates a consistent surplus that can be invested over decades. The goal is not a perfect score. The goal is a financial structure where you don't need debt to function. Here is the system in one structure. Treat the credit score as a lending input while you optimize 3 primary variables that drive long-term wealth: cash flow surplus, liquidity, and low-cost leverage used selectively. Step 1 is a cash baseline. Define your essential expenses number: housing, utilities, food, transport, insurance, minimum debt payments. This is the floor you must cover even in a bad month. Your first target is a cash buffer equal to $1,000, then 1 month of essential expenses, then 3 months. Mechanically, set a separate savings account and automate a transfer each payday until the target is met. This reduces the probability that routine shocks turn into high-interest debt. Step 2 is a strict rule on revolving debt. Credit cards are only used if the full statement balance can be paid automatically every month. Set autopay to statement balance and treat that payment as non-negotiable. If you currently carry a balance, the system changes. You stop optimizing utilization and you optimize payoff speed. Choose a fixed monthly amount you can sustain and direct it to the highest APR balance first. The logic is simple. Removing 20 to 30% APR debt is a higher impact move than any score tactic. When the revolving balance reaches 0, you keep it at 0. Step 3 is fixed cost control. The largest long-term damage from score thinking usually comes from using approvals to justify bigger obligations. Set a rule that fixed monthly commitments, rent/mortgage, car, insurance, subscriptions, recurring loans, must stay below a defined percentage of take-home pay. A practical ceiling many households can work with is 50 to 60% for essentials and fixed obligations combined, leaving room for saving and volatility. If you are above that, you don't need a better score first. You need a lower fixed cost structure. Step 4 is automated wealth allocation. Once you have the $1,000 buffer and revolving debt is moving down, set automatic investing or long-term saving as a fixed line item. Even $200 per month matters if it's consistent. At 7% annual growth, $200 per month becomes roughly $2,500 after 1 year, $14,000 after 5 years, and $35,000 after 10 years. The point is not the exact return, it's the habit of capturing surplus before lifestyle absorbs it. What changes over time if you run this system? After 1 year, you have a meaningful cash buffer, fewer surprise expenses go onto cards, and your score typically improves because payments are consistent and balances are lower. More importantly, your monthly budget has less volatility. After 5 years, if revolving debt is eliminated and fixed costs are controlled, you have options. Job transitions become easier. You can handle mid-sized emergencies without borrowing, and you can qualify for loans based on strong structure rather than stretching approvals. The score is useful here, but it is not the driver. After 10 years, the compounding effect shows up. Lower interest paid, fewer fees, and a consistent investing habit create a widening gap versus a score-first approach. The difference is not that one person is smarter. It's that one person built a system that converts income into assets reliably. What to do right now, in order. Pull your last 90 days of transactions and calculate essential expenses. Turn on autopay for full statement balances on every card that you use for spending. If you carry revolving debt, set a fixed monthly payoff amount and start this month. Open a separate emergency savings account and automate transfers to reach $1,000 first. Set one automatic monthly transfer into a long-term account, even if it's small. The credit score still matters, but in a narrower way than most people treat it. Build the financial structure first. The score improves as a consequence. And when you do borrow, you borrow from a position of strength rather than dependence.